time now to our Bob Pisani with today's ETF Edge. Bob, happy Friday. Over to you.
Hello, Frank. Good to see you. ETFs are poised for a potential $1 trillion in inflows this year. It's an all-time record, potentially. So where are the ETF investors putting their money in the final third of the year? Let's get some insight from Todd Sohn. He's the ETF and technical strategist at Strategas Securities. Todd, a lot of equal weight indices are finally emerging. The RSP, for example, there's been a 2.5-year bear market in these equal weight indices. Is there any movement of investor allocation away from tech and to some of these ignored corners of the market right now?
Yeah, Bob, it's a great question. I think a really overlooked statistic about this bull market. Flows have been all in on technology. And that's been the right call. But I think if you want to look away for less aggressive corners, over the last year, all non-tech sectors have seen negative flows, outflows from everywhere else. And so we believe that as a lot of these other corners emerge from these 2.5 to 3 year bear markets, there is plenty of room to get far more aggressive. And I'm talking about financials, real estate, healthcare to an extent, even materials further down the cap scale. We love the opportunity into 2025 for anything that is non-tech. It doesn't mean be bearish tech, but the aggressiveness just isn't there for all those other corners.
So this is curious to me. We've seen price movements in these corners, financials, consumer staples, industrials, interest rate sensitive like REITs move in the last few weeks and months, but we have not seen large-scale allocation moves into the broader areas of the market. Is it good news or bad news that investors are still not putting a lot of money in these spaces?
I look at it as good news from a contrarian perspective. Of course, you want to see flows go to these other corners because it reflects demand. But investors have been so obsessed with technology and semiconductors and AI that I think they're forgetting about the rest of the index, right? The S&P 490, 493, what have you. And so I like the contrarian perspective of saying, okay, tech is still in pretty good shape, but it is starting to lose some leadership. Look elsewhere, and there's far more room to get aggressive there. It is completely different than 2021, when sentiment was a real risk, and you were seeing flows throughout all sectors plus thematics. It's a completely different scenario than today. And so I think if you're an investor looking to deconcentrate from that top 10 weights, this is where you start to look in all these other corners.
And yet I look into the mega cap areas. I watch the big inflows in the mega. I watch the Invesco S&P 500 top 50 ETF. This is the top 50 stocks in the S&P 500. It's doubled the assets this year, doubled. Now it's almost $6 billion. So it seems like while mega cap tech is lagging this month and not much in favor, there's still plenty of investors believing it's going to outperform in the final third of the year because they keep putting money into that. There's this contradiction here in price of where people are still putting their money.
Yeah, I think there's this saying now that concentration is the new diversification, right? Whether it's a top 50, whether it's the Magnificent 7, or whether it's the upcoming top 20 S&P 500 ETF that's going to come out, investors have seemingly thrown their hands up and said, you know what, I'm just going all in on these mega cap heavyweights. Of course, that's right. It's benefited from it, but I do think there is risk there that those names can peel off, and that's when you want to have the diversification of every other sector that's out there that's more cyclical or rate sensitive than tech is.
Right. So in small cap, for example, here's an example. There's very little inflows into the Russell 2000 ETFs, even though there's been a modest rally, but there's been inflows in the S&P small cap 600 ETF. Now, why is that? Why in the small cap S&P and not into the Russell? What's happening there?
So small caps have gone over 700 trading days since their last new all-time high. That is the third longest streak in about 50 years of data. So the small cap bear market, so to speak, is getting very long in the tooth here. Now, there are problems with small caps. There's a lot of non-profitable names there. There's a lot of boom and bust biotech and regional banks, which have had their fits and starts over the last 2 years. So when you play small cap, you want to have a factor overlay to focus on profitability and quality, or at least look at the actively managed equity ETFs that are out there, because you can have those good managers who know the small cap companies that have worked, say, in consumer discretionary or industrials. I think that's why you're seeing this dichotomy at the flows level between the S&P 600 and the Russell 2000. That's an important part for small caps, knowing what you own there.
So the small cap S&P 600 has more profitable companies than the Russell 2000, and I think that's the answer. Thank you very much, Todd. Appreciate that. Remember, everybody, ETF Edge covers the entire ETF Edge marketplace, and you can see all of our shows on our website. That's etfedge.cnbc.com. Frank, back to you.
All right, thank you, Bob. Appreciate it. Great to see you. Enjoy the weekend.